Hello traders, Gary Wagner here, right around 2 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 5th day of March, 2021, and this is the daily report for gold and silver. Even with a jobs report coming in well over estimate, we saw gold sell off very little in the futures market, actually closing higher in spot pricing. That tells me that the selling pressure we have seen in gold recently throughout this week is subsiding, and on today's show I will make a case for a potential bottom and key reversal which could occur at this particular price point. I hope you enjoyed the show. Interesting action in the precious metals markets, with gold futures declining by $2.50. That's 0.15% and closing below $1,700 at $1,698.20. And spot gold closing a little bit higher, up $1.50 at $1,698.64. However, the Kitco Gold Index does put spot gold just at $1,700. And what is most amazing is the fact that this occurred when the U.S. dollar index gained roughly 0.4% today in trading, which far outweighed the fractional decline in gold futures and the fractional gains in spot gold pricing. We have seen gold futures decline roughly $40 in trading this week, and even though gold did close higher on the day and closed above its opening price as seen in this green candle, it did trade to a lower low as it touched on the lowest price point this week at $1,683. The bearish market sentiment in gold continues without question. Considering the dramatic sell-off of a week ago Friday, that is this candle, we are looking at a Heikin-Ashi chart. We can see that over the last 6 trading days, there was only one day in which there was any kind of upper wick. And when we look at a longer-term view of the market, and I've just gone ahead and compressed this Heikin-Ashi chart, we have hit our initial target that we talked about quite some time ago at around 1690. The market is 1695, so not that far above it. It has touched on an intraday basis below that price point, and the question now becomes whether or not, on a technical basis, we will see some kind of a bounce. We will see support come into the market, because we can genuinely see support in the area of May, June, and July. That would be, of course, of last year, and that occurred right after the decline in March when the pandemic really first took a foothold, and then the tremendous spike that we witnessed following that, all in the month of March and the first week of April. Because from there, we saw the market consolidate through May, June, and it really wasn't until July when we saw the market begin to take off. It then traded above what we are now labeling as the 50% retracement. Of course, that retracement would not have been there at that time because we hadn't hit our highs, and went into one of the most dynamic rallies that we have witnessed definitely since gold hit its former record high. I've just converted back to a standard candlestick format, and just as in the Heikin-Ashi, we can definitively see where this particular price point, $1,700 an ounce, $1,690 an ounce, provided a level of support really before the market took off in July, as we just spoke about, and could once again be a technical area where we could see a bounce. Because really what I am looking at is the fact that this top here was a final fifth wave, and I believe that we're in some sort of an ABC correction. That being said, we could see the market unfold in the following way, and could be witnessing something like an A, a B, and then a final C. Of course, all things being equal, once this C concludes, gold prices would return to an impulse phase in which we would see a series of 5 waves, waves 1, 3, and 5 being upticks, and the corrective waves 2 and 4. which brings us to some potentially bullish news on a short-term basis. If in fact we find support at current pricing, which is where we initially predicted gold pricing would fall to, and we are going to enter a B wave, typically a B wave will run anywhere between 50 and 75% that of the A wave, which means that we could see gold rise to approximately 1880 on the low side and as high as, call it, 1980 on the high side. And that, of course, would mean that gold would first have to find support at current pricing, which is just below 1700, and then begin to form a V formation, indicating that we have in fact hit a bottom before we would turn our basic assessment from neutral to bearish to neutral to bullish. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.